So we had a pretty chaotic week last week in the stock market. The S&P 500 was losing around 1% a day Monday through Wednesday, and then Thursday it finished flat after being down a lot, and then on Friday the Dow Jones was up 370 points before it crashed in the afternoon. This marks the third straight week of losses, and so far it looks like it'll keep getting worse. And it's understandable that people are worried when they log into their brokerage accounts and see that their portfolios are tanking. Because after all, your stock portfolio is your future if you're not currently living off your investments already. If you are currently living off your investments, then your portfolio is basically your life. But if you've consistently been building up positions in companies and ETFs and closed-end funds with the expectation that someday you'll either depend on your portfolio for some of your living expenses or living completely off your investments, then it's a huge deal in your life. And what we've been going through is understandably concerning to us. I don't think I've ever uploaded a video on Monday on my channel before. I've been uploading a video every single Friday for over a year and a half. But I wanted to make this video to remind, or maybe for the first time inform people of some of the most important fundamentals of investing in the stock market as we go through this difficult season. It's absolutely crucial that if the markets keep falling in the months ahead, that you do not panic sell and start selling all of your investments until you think the market is going to recover. Panic selling can cause absolute chaos to your portfolio and your financial future. It's important that we cover this stuff because we've been in a bull market for a very long time, and for a certain percentage of my viewers, specifically people who are probably under the age of 30, it's most likely that this is your first time investing during a bear market. Times were really good starting in late 2009, and with the exception of the COVID plunge, this ongoing market turndown that's been lasting for months is a whole new experience for a lot of people. Or maybe you were old enough to clearly remember the 2008 financial crisis, but you weren't an active investor back then, but now you are. So for those kinds of people, as well as the millennials and the Gen Zers, this is a whole new market. What you're currently looking at is the performance of the Dow Jones index over the last century. We can see some of the largest plunges that have ever happened, like during the market crash of 1929 and the 2008 financial crisis. But keep looking at this. It's important to realize that the market has always recovered and it's always soared higher after these market turndowns. It obviously varies from year to year. Some years it's down, but in more years it finishes up. It's been that way for over a century. So what we're going through right now will come to an end. When it'll be over, I don't know, and nobody knows for certain. Everyone you see on CNBC and Fox Business and all these other news outlets can only speculate on when the market will bottom out. There's plenty of people who thought that the market would bottom out back in June, and it appears that might not be the case if things keep going down as much as they have. But regardless, if you're not dollar cost averaging into your investments, it's something that everyone should be doing. Dollar cost averaging is when you invest money at the exact same time regardless of how the market is performing. It might be investing $50 a week every single Friday or $500 on the first day of the month, but studies have shown that this is the best investing method when compared to attempting to time the market. It's during times like these that I'm really glad that I focus on dividend and income investing over growth investing. Because during periods like the one we're going through, I don't care about share prices as much, I care about dividend payments. In fact, if we're about to go through a long period of time of flatlining share prices like what we experienced starting in the mid-60s, dividends are going to represent the majority of your returns. If stock prices aren't consistently going up, you're not going to be able to make much money by selling shares. In these kind of market conditions, it's dividends that are really going to benefit you. I'm not saying that we are going to experience a long period of time of flatlining share prices, but that's what some people are speculating. But I don't invest in growth stocks and then try to determine when the company's growth is over and I need to sell my shares and put it somewhere else. Take Roblox stock as an example. It's a really popular stock among the growth investing crowd that people tout as basically being the best thing since sliced bread. Kathy Wood holds a lot of shares of it in her ARK Growth ETF and she's been a huge fan of it for a while. Roblox stock is down almost half since its inception. But if this stock does take off and become big, which it could, it very well could, but you have to try to determine when this stock is going to stop growing. Growth investors have to consistently monitor their portfolios and decide when to sell all of their shares and try to find the next big stock that won't be a dud. But as a dividend investor, I always look forward to red days. They're my favorite days in the market because that means my favorite dividend and income stocks are going to pay me more passive income for every dollar I spend on red days. If I have $500 to invest and yesterday a dividend stock I wanted was at $10 per share, but today it's at $9.50 per share, that's great because that means I can pick up additional shares for the exact same amount of money and thus collect a larger dividend payment. And I always make sure that I'm reinvesting my dividends unless I think one of my dividend stocks is currently overvalued. Whether or not times will get better or worse in the days and weeks ahead, it will ultimately get better. We will get through this storm like we always have in the past. Markets always recover and eventually keep growing to become bigger and better than they ever have. But until then, just some general rules for any recession are, don't panic sell and miss out on gains from your portfolio. live well beneath your means, and have an emergency fund if you don't have one already. I'd recommend opening a savings account at a bank that offers a high interest rate. As the feds raise interest rates, then banks should be offering you a higher savings yield on your money. I've used Ally Bank for my emergency fund, which currently offers a 2% yield on all account balances. That's actually a lot better than a lot of dividend stocks out there like Sherwin-Williams and Abbott Laboratories. And if interest rates keep going up, then I expect this 2% yield to also keep increasing. I'm not sponsored by Ally in any way, I've just been a customer of them for years. There's a lot of other banks out there currently offering the same yield if you don't like Ally, but it's a lot better than earning 0.01% interest at Chase or Wells Fargo. Anyways, that's all I wanted to say. I know it's not easy, but just hang in there and don't panic sell your portfolios. If you panic sell, you won't be able to re-enter the market at the correct time and you'll lose out on big up gains during the rebound. And I'm obviously not saying to never sell a position. If you're invested in a crappy company or if you want a tax write-off, then right now is a good opportunity to do that. But other than that, don't take the losses and just hang in there. This is a much shorter video than what I typically post, but my plan is to still upload every Friday. If you guys want more of these shorter types of videos, maybe earlier in the week, please let me know in the comments. But anyways, thank you so much for watching everyone, and until next time, just remain calm.